Okay, hello. Since we missed Friday, or since I missed Friday, I wanted to go ahead and record a video on the beginning part of Chapter 7 so that we don't fall behind like we did with the snow day. So Chapter 7 is moving ahead into the rest of the balance sheet. We're now on to long-term assets. And the thing we need to know about long-term assets, and let's go ahead and go to the notes, is that we're going to be talking about assets that last longer than a year. Well, that's the definition of a long-term asset. Unlike supplies or inventory or other assets that are perhaps shorter than a year, here, a long-term asset has a useful life, and we'll use that word useful life frequently, of more than a year. It is a normal asset, therefore it's a normal balance of a debit. And the thing that we're going to focus on, at least here in the beginning part, is there are a couple of types of long-term assets. We're going to be focusing on, and I'll kind of flip to the bottom here, is that we'll be talking about tangible assets first. And that's going to be plant, which are buildings, property, which is land, and equipment. So tangible assets. And when we talk about them, we're going to be talking about the concept of depreciation. And I'll kind of describe that in a second. Other type of long-term assets are natural resources, things on top of the land like timber, or in the land like oil or coal or iron. And when we talk about those, we talk about depletion. We'll talk about that a little bit later in the chapter. And intangible assets such as copyrights, trademarks, things we own and might go away over a certain period of time. And when we talk about those, we'll talk about amortization. So long-term assets are assets that are useful for more than a year, and therefore we have a kind of a special treatment about how we use them up. When we use up inventory, we expense them through COGS. When we use up supplies, we expense them through a supplies expense. But when we use up things that last longer than a year, we have to have kind of a breakdown, or we have to spread out the using it up. You have to spread out the expense over multiple years. So, for example, if I had a piece of equipment that was worth $1,000, and we're going to use it for 10 years, I would say, just mark off the zeros, that we're going to use it up to the tune of $100 per year. So how do we think about depreciation? We're thinking about using it up, the total value up over a certain period of time, and there are different ways to measure it. But the reason, another way you can think about it, let's say we're talking about an office space, right? If we didn't own the office, we'd pay rent. It would be a rent expense. We would pay it up, every month. If we actually own the office, we still are using it to some degree. It's just not a rent expense. We're just going to be depreciating it over time. So the difference between owning and renting is that we're still going to expense it to some degree. It's just whether or not we're reducing the value of the asset, or it's just a strict expense. But in both cases, we have some sort of expense, some sort of use that we're recording it over time. Now, another thing like we've just studied is inventory. Remember that we studied that anytime that you have inventory, you're going to include a couple of things. Well, there's going to be discounts and allowances and all that stuff. But we included with inventory the freight in. In other words, the necessary money that we spent on shipping to get the product to us so that we could sell it. Well, we're going to have a very similar concept here with long-term assets. And instead of calling it freight in or something, we actually have a whole group of things called capitalized costs. Now, we're going to start using this word here, an expenditure. An expenditure is just a generic form of using cash for something. So it doesn't really tell us what we're using it for. It's just meant that we spent cash. It could be on a couple of different things. If it was on rent, it would be a rent expense. That's one type of expenditure. If it's on something to get if it's spent on shipping, well, that's part of inventory. If we had an expenditure on something to get an equipment or a building ready, we would call that a capitalized cost. So an expenditure is just a general spending of money, and then we have different specific categories of how we spend that money. So I'm going to try and start using the word expenditure, just so as a general spending of money with a few another definition to come. So just like with buildings and lands and other long-term assets, there's going to be a certain amount of expenditures that we spend in order to get those things ready for use. And so whatever money we spend on actually buying the item, obviously that's the purchase price, then we have all the expenditures, and notice that they're using the word expenditure, to get the asset ready for the intended use. So the historical cost, this will be the historical cost, not only the price, but all the expenditures necessary to get it ready for use. Just like we said with freight in. Freight in would be part of inventory because that was a necessary expenditure to get the inventory item to us ready for sale. Now, how are we going to allocate those costs? Once we have figured out what is the historical cost, we're going to allocate those costs in one of these three categories. If it's for a tangible asset, we will allocate it through depreciation. If we allocate it through natural resources, if we allocate natural resources, we're going to call it depletion. And if it's for an intangible asset, we'll be amortizing it. Just note that a capitalized cost is not an expense. Not an expense. Okay, let's go to the next page. I'm going to try and turn off one of these lights because it seems like it's throwing a big shadow. I think it'll still be light enough. Okay. On this page, we're going to look at start off with, on this page, we're going to start off with tangible assets. Now, tangible assets, as we said, we call it plant, property, and equipment. Plant, property, not planty, property, and equipment. Equipment is self-explanatory. Property is land, and plant are sort of buildings. Now, just notice that it's tangible. Because it's tangible, our depreciation we're going to be using depreciation. And the main thing that we want to focus on here is that the idea that of these three, plant, property, and equipment, we're not going to depreciate. I need something heavy for that. We're not going to depreciate. We're not going to depreciate land because we can use up the building, right? The building has a certain amount of life, and the equipment has a certain useful life. But the idea is that property, land, is always going to be there. So we depreciate equipment and we depreciate the buildings, but we do not depreciate land. So here, just remember that, no depreciating land. How do we calculate this? Well, we take, as we said on the first page, we take all the money that we spent on buying the item plus all the expenditures to get it ready, and that becomes the historical cost. So we need a list, basically, of things that we're going to do. So let's start off with land, right? We're going to start off with look at the three different categories. Let's start off with land, and in order to capitalize that, we're going to first notice that you do not depreciate. And what sort of things go into the value of land? Well, it's the original purchase price, then any sort of kind of legal costs that might be involved. Closing costs, costs of grading. So closing costs, those are kind of legal things. And then anything to get the land ready, grading, draining, clearing the property. Encumbrances, that means if you bought it and it had a lien on the property, you would assume the lien. Taking anything down that's on the property, like an old building. But, you could take this building down and you could probably sell some of the material for salvage. Well, that's going to offset the cost. Now, these next two things look like they're very similar. You've got permanent improvements, right? Permanent improvements, and then just general land improvements. Now, if we look at these two lists, they might seem rather similar. You've got roads, drainage, streetlights, sewers. You also got security systems, signage, fencing, paving. What I'm going to say is what you include as part of the cost of the land, as part of the value of the land, you have to think of it in terms of the county and the city, or maybe even the state rules or the state laws about if you buy a piece of property and it has some zoning regulations, there are going to be things that you're required to do as part of owning that piece of property. So look at these as part of, required by law or by ordinance, maybe. And, these are sort of zoning regulations. So you buy a piece of property, you've got to make sure that if the area stipulates that a road needs to go through there, that you address that it has drainage systems, sewers and street lights. So you can see where all of these are kind of required, right? These are not, you can't get away with not doing those. But when you look at land improvements, fencing, paving, now does the city care whether you have a paved parking lot or if you've got a gravel parking lot? There might be some regulations, but typically security systems, signage, and lighting, those are not things, those are kind of nice to have, right? Nice to have. They're not required. Not required. So these might be things to make your business look nice, but these are extra things that you're deciding to pay. So if these are nice to have items, things that look good or will help your business kind of do what it needs to do, we keep those separate. Anything that's required by the city or by the county or by the state zoning regulations, then we're going to say that that's the actual part of the cost. And just remember, it's all expenditures to acquire the land and to prepare the land. If we look at the next one, we're going to move on to the concept of equipment, or the category of equipment and machinery. Similar. So land, I guess I should point out, it says land has an unlimited useful life, right? Land has an unlimited useful life, therefore we do not depreciate it. In other words, the land is not going away. But when we talk about equipment and buildings, they have a limited useful life, therefore we do depreciate. That's the difference. So what goes into it? Well, it's the purchase price, of course. And then just like with inventory, you've got freight in, you got freight charges, assembly costs, preparation of the facilities, employee training. Now notice here, it'll be for the initial run or trial run. And in other words, any money that you're spending to get the piece of equipment up and running for the first time, before it's in regular use, that would be capitalized. That would be part of the value of the equipment and machinery. Things you might not include are just regular maintenance, ordinary repairs for damage during installation. So those are, well, of course, repairs during installations may not be an ordinary maintenance, but those aren't required to actually get the machinery up and running. Where you may have had to fix something, but that was your own fault. That wasn't like a normal standard cost. When we talk about buildings, again, limited useful life, therefore we depreciate. We're also looking at the historical costs. So here we've got closing costs, brokerage commissions, so all of the necessary legal requirements to buy a piece of to set up a building and get the proper permits, sales taxes, attorneys and architects fees, building permits, renovation, contractors costs, all those sort of things. So we could go to activity 1, but I'm going to actually try and cover both activity 1 and activity 2 as far as the notes, and then we'll do both activities together. So here's something that's somewhat related, but it's a little different. So we're talking about buying long-term assets, buying land, buying machinery, equipment, or we're buying buildings. And sometimes those are all very detailed, right? We get the information about how much each part of it costs. Once in a while, we may have a a situation where someone says, I will sell you the land and the building for an all-in-one cost of something, $1 million. Now, individually, the building might be worth something and the land might be worth something different. That's maybe more than 1,000. So how do you go about figuring out how do you allocate the cost to those two items? And that's what we call a lump sum purchase. When you're buying several long-term assets for something different than their market price, they might, individually they might be worth something more, but when you buy them as a group, maybe you get a little bit of a, I don't want to say discount, but get a little bit of a good deal. So how are we going to record that? And I'll just say the best thing to do is, so we're talking about several types of assets, is that we're going to allocate it. And we're going to have a special way of allocating it based on the market values. So when we get to the activity, it'll be easier to show you. But just realize one of the things we're going to do is do some calculations about what do you do, or how do you figure out the values for the balance sheet about different assets if you buy several assets at once for one all-in price. Okay, the last bit of notes that we're going to go over here is expenditures after the acquisition. So once in a while, so most all of the capitalization happens when you first get the asset ready for use, right? So, bringing the machinery and installing it, getting the building set up, preparing the land, all those things are going to be capitalized costs, are going to be part of the asset, the original historical cost. Now, later on, almost all the expenses are going to be sort of regular maintenance or repair type expenses. But there are a couple of things that later on are going to be expenditures that we will capitalize, meaning we will actually add that to the value directly to the value of the asset. And what are those? So if we take a look at the list here, we've got examples of, let's say we have a truck, says a major engine overhaul. We've got We've changed the body of the truck, like maybe we changed it from a flatbed truck into a refrigerated truck, additional storage capacity of the truck. And this is just an example for a truck, but it could be anything, changing the machinery. Now, what do these all have in common? Basically, what we're saying is we've almost made a big change to the asset. In other words, it's almost like a different type of asset. Right. And so if we make such big changes that we actually change the nature of the use of the asset or prolong it, like the engine overhaul, it's basically, we said the truck was good for 10 years, but now with the overhaul, it's good for 20 years. Well, that's changing the life of the asset. So these we're going to capitalize. And these would be expenditures after the original setup. Now, what sort of things are just normal that we expense? Oil changes, at least in the example of this truck, new tires, a paint job, repair, but simple repairs, replacing the carburetor or something like that. And so these are just going to be expenses. Where these are changing the nature of the asset, those are going to be capitalized. Okay, let's take a look at the activities. Page 13, I believe. Nope. Page 14. Okay, so all we're doing here on page 14 is we're taking an example of a piece of land and then a piece of machinery and just going through and testing our knowledge about what things do we capitalize and what things do we not. In other words, just making sure we understand that list. So when I start going through this items, we're obviously going to have something about land. And we're going to kind of start off there. What things do we add to the value of the land? So if I read through it, it says we plan to construct a small office building by paying $100,000 in cash. Okay, so that's the original price of the land. An old warehouse in the property was razed. In other words, we had to tear it down. Well, that was necessary to get the land ready. So we're going to add that expenditure to the value of the land. The salvage materials was sold for $1,700. We spent $6,600 tearing down that building, but we got back $1,700 because we sold off some of the salvage materials. So that offsets the $6,600. Additional expenditures before construction began included $1,100 in attorney fees. Okay, well, that was necessary to get the land ready for use. And I'll just point out that just double check. Sometimes the attorney fees are for something else, but here we see the attorney's fee was for the land purchase. So if it's for the land purchase, well, that's obviously part of the land, getting the land ready. $4,000 real estate broker's fee. Yep, the real estate agent gets their fee, and that's part of the value. In other words, what we put, like freight in, we had to pay that to get the land. So that's going to be part of it. And then it says $7,800 architect fee. Well, an architect fee is going to be for the building that we put onto it. Now, why would we have the architect's fee this early on? Sometimes you engage the architect early on just to make sure that you're buying the right piece of land, or something about the land is not going to be, like it's too swampy, or there's not enough there's not enough rock in the ground to keep it stable. But you might engage an architect early on when getting the land ready, just to make sure that the building that you're going to put on it will be worthwhile, or at least will be stable. So that would be a building fee. So if I keep going down, $7,800, $14,000 to put in driveways. Well, again, that doesn't sound like necessary, right? You would think, yes, of course you want to have a driveway and parking lot, but that might not be stipulated by the accounting regulations or the city regulations. So that would be something we would call a land improvement, and it would go in its own separate category. So $14,000 here. And then the next one was $5,200 to install fencing. Well, that one's a little more obvious. We don't necessarily have to have fencing. It's not the city telling us we have to have fencing, but we want fencing. So that's more of the nice to have. $5,200 for that, and determine the amount for the cost of the land and land improvement. Okay, well, so the building's going to have $7,800, but rather than totaling up here, probably when we build the building, there's going to be a lot more that gets added onto that. Here, let's see, I've got 10, 6,600, 1,100, 4,000, and I got 1,700 on this side. So the debit and the credit total, and then so the land is going to be 110,000. So the land improvements are going to be 19,200, and the building, at least so far, is going to be 7,800. Okay, so let's take a look now, but we're going to be talking about a piece of equipment. So the equipment, I'm going to start off here. And we're just going to read down and do the same thing. It says, Ruby Company purchased a piece of equipment with the list price of $60,000 on November 1st. So there's the price of the equipment. Expected to last 10 years. The following amounts were related. Terms of the purchase were 210 net 30. Ruby paid for the purchase on November 8th. Okay, so that's within the 10 days. So if we said, well, how much discount is that? Well, that's 60,000 times 2%. So that's going to be $1,200. So that's basically reducing the price, right? We got a discount on this piece of equipment. So $1,200. The freight costs were $1,000. So that's freight in, right, to bring the piece of equipment to us. So that gets added as part of the equipment. State agency required a pollution control device be installed on the equipment at a cost of $2,500. Well, that makes it very clear, right? It's a state regulation, and it's saying it's mandatory. So there's no guessing there. That's obviously part of the equipment price. We have to spend that to operate, to get the equipment ready to run. Ruby had to widen a door. The door widening cost $700. Again, anything that we need to do to, adjust our facility or, make our facility right, in this case, to get it through the door, becomes part of the cost of the equipment. During the installation, the equipment was damaged and repair costs of $4,000 were incurred. Well, that's not part of the cost of the equipment. That was kind of our own fault. In other words, it wasn't necessary. In a perfect world, we wouldn't have damaged it. So that would be just a repair expense. $300 of lubrication was applied to the gears of the machine prior to, and that shouldn't be trail, that should be trial, to the trial run. So remember I said any cost that we do to get the to get the machine ready for its initial first run, for its trial run, is going to be part of the cost of the equipment. Anything after that is going to be maintenance. So here the $300 would be part of it. We've got Ruby anticipates the yearly maintenance to keep the machine running will be $500. Well, that feels like it falls squarely in stuff that happens after we started running the machine, right? Annual maintenance is going to be $500. And then we talked about, what's the next thing? Ruby purchased liability insurance to cover the damage to the asset. 3-year policy costs $2,000. Now, that's not required, probably not required by the state, but it's good business sense, right? We're going to spend that money, but it's not necessary to actually get it running, at least according to regulations and whatnot. But we're still going to do it because, well, it makes sense to insure. So we're going to have a prepaid insurance because we're paying it up front. And then we've got training employees to use the machine at a cost of $6,000. So I'm reading this as this is the initial training, right? The training the first people to get it running, not subsequent like retraining or training new people afterwards. This is the first run through. In other words, we need to have people who know how to run it to get it running the first time. So I would add that in as part of the equipment because it's kind of the trial run training. So we have a $1,200 credit. And all of these added together are $70,500. So the cost of the historical cost of this equipment, the historical cost is going to be $69,300. Okay, so let's take a look at this other activity, and it's rather straightforward. We talked a little bit about this lump sum when you're purchasing several different assets for an all-in-one price. How do you actually divide up the price you paid and apply it to the different assets? So lump sum, let's look at them. Here we've got a situation where we acquired a printer and an office chair for $1,000. Now individually the printer was $700 and the office chair was $800. Well, you can see that those add up to $1,500, right? If I bought them individually, the printer was $700 and the office chair or office chairs was $800. So the total, it would have been $1,500, but how much did we spend? We spent $1,000. So how do I divide up the cost? How do I divide up the $1,000 I actually did spend between the printer and the office chair? Well, we're just going to allocate it based upon, as we mentioned, upon the market value. If this is how much they are worth individually, what I say is, okay, I'm going to figure out a percentage. What is the percentage $700 out of $1,500? So 700 divided by 1,500 comes to the very messy 46.7%, right? In other words, if I bought them separately, they would have been worth $1,500 and the $700 would have been 46.7% of the total price between the two. And then, of course, the same one with this. Well, you can figure it out, or you can just notice that it's going to be the other bit. It's going to be 53.3. So what we want to do is we want to maintain this ratio, right? Maintain this ratio, but with the $1,000. So how do I do that? I say the printer is 46.7% of the $1,000, right? And so that would make it $467, and that the office chairs are 53.3% of the $1,000, and that's going to be $533. And you notice when you add these two together, well, you get the total $1,000, right? All you've done is breaking them. You've created a percentage based upon their market value. Originally, their market value was $700, $800. Total together is $1,500. So that means if I had bought those at the market value, the difference between them would be 46.7% and 53.3%. So I just use those same percentages and apply it to what I did spend, the $1,000. So let's look at this again, but with another example. So here, instead of two pieces of equipment, printer and office chair. Here we're going to look at like several different items. So you notice we've got FMV stands for fair market value. And so the M is market, right? Market value. So if I add these three, if we bought them independently, it would be 100 plus 350. So that's 450 plus 5. So if I add these up, the market value would be 500,000. But how much did we spend? We spent 450,000, right? So what I'm going to have to do is the exact same thing. I'm going to have to figure out what is the percentage of 100 out of the 500, the 350 out of the 500, and the 50 out of the 500. Figure out the percentages of the market value and apply it to the 450. So if I just divide each of these by 500, well, this one is going to be 20%. This one's going to be 70%. And this is going to be 10%. And you notice it is important that they do equal 100%, right? It doesn't work if it doesn't equal 100%. So what would I do? I would take the land and I would say, and the building and the equipment. And I would say, all of these, I spent 450,000, right? But the land is supposed to be 20% of it. The building is supposed to be 70% of it, and the equipment is supposed to be 10% of it. So if I multiply 450 times 20, that's going to be 90,000. If I multiply 450 times 70, that's going to be 315,000. And 10% of 45,000 is 45,000. And again, just like this has to equal up to 100%, this has to equal the 450,000, right? And so does it. Let's see, that's 3, 4, 5, 6, 360. Yep. So this would equal a total of 450,000. If I was doing a journal entry, it would be, debit, land, building, and equipment for those numbers, and it would be a credit to cash. Okay, I think that's activities 1 and 2. We didn't spend too much time. We spent about a little over 30 minutes. So that at least will give us a little bit of a head start heading into this week. We ended a good place because the next thing we're going to be talking about is the actual depreciation methods. So that's going to be a good place for us to start. Okay, I will see you this week and we'll get into chapter 7. Thank you.